Good morning, everyone. Thank you for joining us. The webinar will now begin. Before we get started, we just have a few technology tips to keep in mind when you're viewing the webinar. The first is that all attendees are muted throughout the presentation. Every once in a while, make sure to tap your mouse so that your screen doesn't go idle or black. And there will be time for questions and answers throughout the presentation, so just type them in during the presentation at any time, and then following the presenters, we will ask them the questions. A recording of today's presentation will be available for playback on farmcrediteast.com. And if you have any troubles accessing this recording, please contact Christy Schmidt at 1-800-562-2235. And now I'll pass it over to Jim Putnam to begin.
All right, well, good morning, everybody. On behalf of Farm Credit East, we welcome you to this Dairy Outlook webinar. We've done one of these, I think, for about 5 years now. And it's a tradition that we find a lot of value in. We especially welcome our customers and guests from dairy industry throughout the Northeast this morning to this opportunity to learn together. We're going to do brief introductions of the speakers, but not use up too much of our time with long-winded introductions. I want to reiterate what Christy said. Encourage you to text in questions using the panel in your computer display. Best questions are the ones that come from you folks because they really give us an opportunity to understand what's on your mind as well. So, with no further ado, I'd like to introduce Dr. Mark Stephenson. He's a returning speaker to this event. And he is the Director of Dairy Policy Analysis at the University of Wisconsin in Madison, where he's been since 2010. So the deal is, I think those Badgers stole Mark from us. He'd spent almost 20 years at Cornell University, and we got to know him real well. So he had an opportunity to return to Wisconsin, and he took that, but we're glad to be able to keep up contact and share in his expertise. Mark's got a lot of knowledge about the dairy industry. He's nationally recognized, speaks in a lot of different venues. I am told that he recently spent time in New Zealand and Australia looking at the dairy industry down there. So, with no further ado, Mark, take over, and we look forward to hearing what you have to say about dairy for 2013.
Well, thank you, Jim. I appreciate that introduction, and I'm happy to be out here in Wisconsin, although I miss my friends there in the Northeast quite a bit. But I wanted to talk a little bit about the dairy situation and outlook today, and as in most years, there's always a story that develops. I don't always know what the story is going to be until we get to the end of the year, but there's usually something that's been impacting dairy markets quite a bit and we think provides the momentum to carry us into the next year, and we've certainly had that this year. And, you know, this year, this is the milk price story. It doesn't look a lot like milk directly, but these are things that are known as the Southern Oscillations, and they provide us with weather patterns. Quite often it's an El Nino pattern. El Nino gives us, without strong trade winds going from east to west across the Pacific Ocean, it gives us a warmer body of water there, and that tends to provide wetter weather in the U.S. and drier weather over in Oceania. What we've had for the last 2 years has been a La Nina pattern, and that La Nina pattern are really strong westerly trade winds, and those westerly trade winds tend to push that warmer top surface of the water over toward Oceania, and that indeed gives a little bit of extra weight to the ocean on that side of the ocean, and it pushes up this colder body of water over here. That gives us relatively dry and warmer weather in the North and South America, and it provides usually much wetter weather over in Oceania, Australia, and New Zealand. And that's really been the milk price story. So I'm going to talk a little bit about some of the impacts of that. Well, for us, of course, one of the direct impacts that we've been very much aware of is the drought. Now, the drought's been all the story this year, but if you remember back the year before that, we actually had drought then as well, but it was more or less confined to Texas, Oklahoma area. And this year the drought has been much more widespread, covering something like 2/3 of the country and directly impacting milk production. Not so much in the Northeast, but an awful lot through the center part of the country, and it certainly has impacted the major grain growing areas here and had an impact on feed prices. If you look at the National Ag Statistics Service value of the dairy ration over some period of time, you will all remember, I think, late 2008 going into 2009 when we had quite a run-up in feed prices. And that was mostly driven by oil prices. You may remember we had $140 a barrel oil, and we were looking for renewable fuels, and ethanol seemed to fit the bill there, and it ran our corn values up rather considerably, and soybean and hay values followed with that. It was a doubling of the ration value in a short period of time, but it didn't last long. It was a spike, dropped back to what many of us thought at the time in 2010 was probably a new plateau for prices, somewhere around $7 for 100 pounds of ration instead of the $5 that had been more normal for us well before that. But that didn't last very long either. The drought and its impacts and demand for feed grains globally has really pushed the price of the value of the ration up to new heights, well over $12 for 100 pounds of ration now, and this has had a big impact on dairy producers throughout the country. One of the impacts that it's had has been on milk production per cow. This is a graph that's showing you pounds of milk per cow per day and over the period of the last 5 years. And starting in 2008, you'll see that seasonal pattern that we have in milk yields. And you'll see the annual kind of increases that we've had. Those haven't actually been as big as we would normally expect, although the jump from 2009 to 2010 was fairly strong. The first more than quarter, not quite half of the year in 2012 gave us pretty big increases in milk per cow as well, because we were enthusiastic about milk prices coming out of 2011. But those high feed prices this year have really put the skids on milk production per cow in the second half of the year. So we've had essentially no increase in milk productivity the last half of 2012. It's also impacted dairy cow numbers. You'll notice that 2009, that purple line that's going from the top left to the bottom right corner of the graph, shows you the sharp decline in cows that we had during a very bad milk price year. 2009 was a hard year for dairy producers, and after that we've had some recovery. 2010 and 11 began a gradual drift in replenishing those cow numbers right up through 2012. In the first half we were increasing cow numbers as well, but then we began to see that decline. And here we've been seeing culling of the herds, and we've also had some opportunities to sell cows as cull cow values. As a result of drought and high feed prices, there's not much in the way of beef on the hoof, and so cull cow values have been really quite strong. You'll see that here in this chart. We've been at a level that's been around 80 cents a pound for cull cows, way above our more average 40 to 50 cents a pound. So if you feel like you can't feed cows because of high feed prices, culling cows has been a fairly good alternative to milking them and thinning the herd out a little bit. The percent of heifers in the herd, heifers as a percentage of cows, used to be fairly stable, around 42 to 44%. But since the turn of this decade, 2000, it's been increasing. We've been keeping more heifers as a percentage of cows. That's given us the potential to cull our herd more heavily or to grow the herd more rapidly if we chose to do that. And you'll see here that just this last year in 2012, we've actually had a reduction in that number of heifers as a percentage of cows. And I think that's been happening mostly because we've been selling heifers as beef cow animals as well. Again, the beef cow prices have been fairly high, and if the returns to milk have not been good, we've found that we actually wanted to cull some heifers. I was talking with California dairy producers a little while ago, and they indicated that for them, raising a heifer from a calf to a lactating animal was going to cost about $1,900, and a springing heifer can be purchased for less than $1,900, and it didn't make sense for them to be raising these animals, and so they've been culling heifers out there as well. This has some implications, I think, for rebuilding the dairy herd in the future if we continue to cull heifers heavily. We simply may not have as big a supply. I mentioned California and the western herds. I wanted to talk just a little bit about some different business models because it does have an impact on this story this year. I'm going to separate it into farms in the Northeast or the upper Midwest that I'm calling traditional style dairy farms versus western style dairy farms. Traditional farms will typically own enough land to grow at least their forages, to house and milk the cows, and to spread manure on that land. Western style dairies only own enough land to store the feed and house and milk the cows. They don't grow the crops. The traditional dairies are smaller on average in terms of herd size than the western style dairies. They tend to have a somewhat higher average milk price, although it's not hugely larger, but somewhat higher. And this is the important part. It's the makeup of the costs of production because they're owning the land and growing their feeds that differs between the traditional dairy farms and the western style farms. Traditional farms have a much lower variable cost of production and a higher fixed cost of production. That has real implications when we're getting into some of these periods with high feed prices or low milk prices. If you look at this chart, it doesn't go through our current time period, and the reason is that this series of prices has been discontinued, but it does go through a very important time period of 2009. I'm showing you 4 states here. 2 of them what we might consider to be traditional states, Wisconsin in the blue and New York in the red, California the green line, and Idaho the purple line. And this is the net income just over feed costs. Not all variable costs, just feed costs. And you can see here that the Wisconsin and New York lines have some favorability over the western style dairies. And when we get into a year like 2009 where the margins were severely stressed, you'll notice that California and Idaho dairy producers had many months when they were not even covering their feed costs, let alone all of their variable costs of production. The implication of that is you'll lose less money if you don't milk cows than if you do milk the cows. So California and Idaho and New Mexico and Texas dairy producers found during 2009 that they had to cull their herds heavily, and they looked within that to get rid of cows. Let's take a look at the change in U.S. milk production. This is just a percentage change from 1 month in a given year over the same month a year earlier. Most of the time in the U.S. we have something like a 2% increase in milk production, but there's a lot of variability. Sometimes the growth is well more than that, sometimes a little bit less, and you'll see in 2009 that we had a time period when the U.S. actually contracted, when they didn't produce as much milk as they did the year earlier. You'll also notice that clear out here in the end of 2012, we had a couple of months when we didn't produce as much milk as we did the year earlier. So not often that we have time periods of contraction in milk production, but it does happen. Let's look at a couple of different states that may represent that. Here's New York, change in milk production. Now New York is growing something like at the national average around 2%, but the scale is the same in both of these charts, by the way. But here's 2009. You see that we had some time periods when New York was contracting, but not too strongly, just a little bit. Most of the time they've been growing through it, and here's 2012, and you don't see any of that little contraction that was shown in the U.S. This is Wisconsin over the same time period, another state with traditional farms. And again, 2009 did not show any contraction. We had a little problem with temperatures in 2011, and we did have a couple of months of contraction there, but 2012 again didn't show up. So Wisconsin was not contributing to the declines in 2009 and 2012 to the national averages. We were, in fact, growing through that. Here's California. Okay, California is, again, same scale here, but now they're using all of this scale. There have been time periods when California's had as much as a 10% increase in milk production, and their average is much higher, maybe around 4% in much of the growth periods. But now look also at this contractionary time period, losing as much as 6% of their milk production, 5% of their milk production. California and the Western-style dairies are the ones that have to contract because their variable costs of production are higher. And that has implications, I think, as we move forward. So conclusions, high variable cost business models make you really agile, and you're able to respond to price changes quickly. And it's fun on the upside, but it's no fun to have to contract. As we've had margins become very volatile in the dairy industry, these traditional farms obtain a measure of risk management because the grown feeds that we have are considered a sunk cost. We've got them in the bunk, and going forward, we're going to feed them. Let's change a little bit, shift to looking at some of the demand for dairy products. This was part of the story this year. You may remember a month or two when we had a fair amount of media headlines talking about fluid milk sales. Well, fluid milk sales have certainly been in decline, no question about that, but they've been in decline for a long period of time, not just recently. And the difference was that this year our decline has been a bit more rapid, and more importantly, we hit a nice round number as a milestone when we dropped below 20 gallons per capita average milk consumption in the United States. Well, fluid milk consumption has a lot of competitors in the beverage space, and we have been losing ground there. And while I think that it's something for the dairy industry to look at and to work on and think about, I'm not sure it's something we ought to obsess about. But it does talk to strategies going forward. If we aren't going to have the fluid milk sales, we need to think about other category possibilities. Here is a graph that's looking at the per capita consumption of all dairy products. And you'll notice that that looks very much different than that graph I just showed you of fluid milk. This is showing you increases in per capita consumption of dairy products over the last many, many years here. And that increase in per capita consumption has been due not to fluid milk, but mostly to cheese and more recently other products like yogurt that have been really capturing the interest and excitement of the U.S. consumer. So consumption of dairy products is not a bad story to be able to tell, but fluid milk is not the stellar star here in the dairy industry. I've shown this many times before, and I like to put it up here. This is the Restaurant Performance Index. This has much to do with dairy because about a third of dairy product sales are consumed through restaurants. And as the restaurant industry goes, so goes the dairy industry in many cases. You'll see here 2009 looking like the bottom for the Restaurant Performance Index, and that was very true. It had some implications for fluid milk as well, though, because as consumers were no longer going out to eat in restaurants and staying home, they rediscovered the dining room table, they bought more milk, and we had an uptick in fluid sales in 2009. It wasn't persistent for us because as the economy recovered and people began to eat out more, fluid sales have dropped. But I am a little bit concerned about what's been happening this last part of 2012. This is not a good trend over here where we see the sales declining. It's not just our domestic sales, though. Well, we've entered the export markets in a pretty big way. These two lines, blue line is the value of exports, the red line is the value of imports. And you'll notice that by about 2007, we had entered the world market for dairy products. 2009 was a time period that we had a global recession, not just here in the U.S. When that happened, our export sales opportunities kind of fell apart like you see there. Those additional milk supplies got pushed back into our markets, and we ended up having to balance the world milk supplies. And of course, Western dairy farms were really balancing the U.S. and thus the world milk supplies. So that was kind of an issue for us. The export sales have recovered. This year, just finished 2012, we exported pretty close to 13.5% of the milk solids that we produced on farms. We're a major exporter. So that means, as we're in these export markets, that what we're doing now and contributing to world markets impacts other countries, but what they do also impacts us, and we have to keep our eyes on what's happening overseas. This chart just shows you two different things. One of them, in the blue line, is the percent change in Oceania milk production. That's Australia and New Zealand. That's measured off the right-hand axis. And the red line is showing you the percent change in U.S. export value measured in the right-hand axis. So you'll notice that when we have big increases in exports of dairy products, value of exports, it tends to be at a time when Oceania is contracting in their milk production. Oceania faces not price risk so much as we do, although they face the same up and downs in prices. They don't have to change milk production decisions as a result of that. They mostly face production risk. If they get good rains and their pastures are in good shape, then they produce a lot of milk, and there's less room in world markets for us to sell dairy products. So what happens overseas matters to us. If you take a look at these international farm gate prices, you'll notice that over a time period from about 1992 until through 1910 is the data that I have here. I'm showing you the European Union in the dark blue line. The dashed line on the top is Canada. The blue lines on the bottom are Australia and New Zealand, and the red line is the U.S. These are farm gate milk prices in dollars per hundredweight. We were not a major player at all in U.S. dairy markets until, if you remember, about 2007. And looking at this chart, I think you can see that that was a time period when U.S. prices kind of converged with all of the major exporting countries in the world. Canada is not an exporter. Canada has their own program going on with strict milk control quotas and relatively higher milk prices, but not the ability to really grow their milk production if they want to. The rest of the world here, shown as the EU and the US and New Zealand and Australia, are duking it out for sales, and our farm milk prices are not much different in any of these countries. So we've had a convergence of these milk prices as well. Let's take a look at stocks numbers. I always like to look at those because I think of them as being kind of the canary in the coal mine. They tell us something about whether we're in a good place. If the stocks are relatively short or tight, then we probably are selling more than we're producing, and we're drawing our stocks down, and it's usually an implication that prices should be higher. If we are producing more than we're selling, stocks will grow, and that puts downward pressure on prices pretty quickly. These are the butter stocks, very seasonal pattern to that. And as I look at these several years in here, I would look at 2012 and where we've come with our last numbers on dairy stocks and say, pretty average year, pretty normal for us. Certainly nothing out of the ordinary. And in fact, relative to the first part of the year when we were growing a little bit more in stocks numbers, we've kind of pulled them down to where they're below the levels they were at in 2009. If you look at cheese stocks, this is even a little bit different. Cheese stocks would indicate that we're actually tight on cheese supplies. We don't have anything extra here in the way of cheese stocks to stand behind. I don't think that we're in panic mode yet, but these are tight and should suggest stronger prices for us. If you look at non-fat dry milk, also in the ordinary range, but if anything, a little on the tight side. Now, when you look at something like the spot markets, the Chicago Mercantile Exchange prices over there, this is what's been happening to the block cheddar price. And it did increase over quite a period of time while stocks were being made tighter. And then look at this drop that we had. strongly in the value of cheese, and it's pulled down our milk prices as well. That doesn't seem consistent at first glance with the stocks numbers and what's been happening. And here's where we have to tie this story together with our international place. These are showing you the Oceania prices in green and red, and those are two series that the Ag Marketing Service announces. It's the high price and the low price for cheddar cheese. And the dashed blue line on here is the NASS cheddar price that's announced weekly. And you'll notice that most always our prices sell at a slight discount to world market prices on products, including cheddar cheese. And if you go over clear to the right-hand side of the graph, you'll notice what was happening here. Here are stocks getting tight for us. Here's our markets responding with higher prices. And as those markets responded to higher prices, we became out of alignment with Oceania prices, world prices for product. And in fact, those world prices drew us back down. Even though our stocks are tight, we can't get too far out of alignment with world prices now, or we're going to be reined back in. So while we think about things like a block barrel spread on prices, and those have to be in some kind of normal range, or they get arbitraged back, I think we now have to think about U.S. and international prices in the same way. So some observations. The La Nina has caused widespread drought in the U.S., bountiful rains in New Zealand, and as a result, U.S. milk production has been declining, or at least not growing, and New Zealand's milk production has been growing. Without the drought, if we didn't have the drought, and we had a rather normal year here, and if New Zealand had, less of a strong production year out there, I think we would have been putting a lot of dairy products out on world markets. And if that were the case, we would have found ourselves in something more like a 2009 marketplace, and we would have had a milk price problem, not a feed price problem. This year I would characterize mostly as a feed price problem, not so much a milk price problem like 2009 was. But the milk price problem affects producers all over the country. Everybody that produces milk is impacted by milk prices. Not quite so much true with feed price problems. It impacts the Western style dairies much more than traditional dairies. So here's my price forecast. I don't think that the U.S. product prices have much further to fall. In fact, we're now back into the gap having been closed. I also think that world prices are going to increase a little bit to continue closing that gap and put us back into a normal price relationship in those world markets. So even though the futures markets in the last week or so have shown some decline in nearby months, I don't worry about that too much. I think that we're going to find that those market opinions turn around fairly quickly. My price forecast has the Northeast prices up about $1.50 a hundredweight in 2013 above 2012. So my projections are fairly flat out there, but I think that the error in forecasting would be that the second half of the year could be too low. If we find that, in fact, milk supplies have not grown very much, and I think we find that world prices are strong relatively, then we could have much higher prices than I'm forecasting. We also have futures markets forecast for soybean meal declining by about $70 a ton over the course of the next year, and by the time we get to the next harvest season, corn prices are forecast to drop, not quite, but almost by $1 a bushel next harvest season. That will together really improve the margins for dairy producers. The uncertainties, I think, are next year's weather. If we have another normal year for moisture, I think we're in pretty good shape. If we have another dry year, another drought type year, and high feed prices, we're going to be in tough shape. Many of our producers, even in traditional parts of the country, have exhausted the carryover feed supplies they've had, and they're going to need to be looking for those to be replenished this next year. Europe's sovereign debt problems haven't gone away. If we find Europe's beginning to default, one country or another, on sovereign debt, then the U.S. recovery is fragile and it could be threatened, and Asia's strong demand for dairy demand could also be challenged. We also don't have a farm bill passed. We will have, well, this is not quite up to date here, sorry about that. We will have MILC payments, I expect, in the next several months. They aren't going to be large, but we are projecting February and March to have maybe 30-cent or 40-cent payments possibly. And so MILC could come into play in there, but not in the second half of the year, in my opinion. At that point, we're about at time, but maybe we have time for one question or two.
All right. Well, thank you very much, Mark. Your usual nice job of covering the waterfront. Appreciate the tie-in to events in other parts of the world, and as we become an increasingly global industry, it's important for us to pay attention to those kind of fundamentals, and some great charts here as well that I think not only help us understand the case you're making, but teach us a little bit more about the dynamics of the dairy industry here in 2013. We would like to put you on hold here for a few minutes. Let Dr. Terry Barr speak to kind of the rest of the outlook, and then do a joint Q&A session with both of you. Would you be okay with that?
Oh, certainly.
All right. Well, then I'm going to go ahead and introduce Dr. Terry Barr. Again, he's becoming known to a lot of you as a go-to speaker on our webinar programs. He's a good friend of Farm Credit East. Again, somebody that I've had a lot of professional experience with over the years. And he is employed by our partner, CoBank ACB in Denver, Colorado, Farm Credit East lender. And he is a senior director for CoBank's Knowledge Exchange division, and really their nationally focused agricultural economist. He formerly served at the National Council of Farmer Cooperatives in Washington, D.C., and had a tour of duty at the U.S. Department of Agriculture prior to that. So a lot of familiarity with diverse agriculture in the United States, global issues, and all of the data and analysis that comes out of the USDA. So with that, I'd like to welcome back Dr. Terry Barr.
Thank you. Pleasure to be with you, and I appreciate everybody taking time from their busy schedules to participate. I'm going to quickly kind of give you a snapshot view on the grains complex. Obviously, it's a little difficult at this point in time. It's very early in the season yet, but I think there are some important changes coming that we need to talk about and so forth. One of the first things I want to discuss a little bit is this notion of transitioning in commodity markets. So although we are very focused on obviously 2013 at this point in time, I think it's good to keep a perspective on these commodity markets. This slide is just the CRB index for agriculture, or the World Bank index for commodity index. And I just want to make some points about, the stability in commodity prices really from through the 80s and 90s, when we had grain inventories that were really kind of around a 25% stock to use. Then we went through a transition period where we had really extremely strong global growth with both the advanced economies and the emerging markets growing very rapidly. That emerging middle class began to be a big dominant factor in the marketplace, and we moved this whole price scenario higher and so forth. And then, of course, we hit the global recession and the financial crisis, Lehman Brothers, et cetera, et cetera. And you can see the last 5 years have really been significant economic turmoil and so forth, making it very difficult to kind of sort out kind of where is that new normal on prices as we go forward, whether you're talking about dairy prices or you're talking about feed grain prices and so forth. Really have got no gauge at this point in time of exactly where we're going to settle out on these prices because of the uncertainty that's out there in terms of transitioning to a different scenario. And so, when I look forward, again, recognizing that a lot of the focus is on 2013, if you begin to look at kind of a 5-year scenario and so forth, go back and look at the last 5 years, what drove these last 5 years. Obviously, the global financial crisis was a major driver to begin with. Recessions in the advancing economies, importantly, rising fiscal deficits in terms of massive infusions from the government in terms of running deficits to come out of that recession. We also had central banks putting tremendous amounts of liquidity into the marketplace and so forth, to the tune of $6 or $7 trillion if you total up all of the central banks and so forth, and obviously very low interest rates in that regime. As I mentioned, the emerging markets actually did continue to grow despite the activity, the weakness in the advanced economies. And that middle class continued to emerge through the emerging markets, was a big factor in shifting some markets. We had rising energy prices as this overall demand really pushed the energy markets to the edge and so forth. In the U.S., and I think Mark alluded to this, the rapid growth in biofuels began linking agricultural commodities to oil prices. So we had kind of a pressure coming from both the renewable fuel side as well as the emerging markets. And then we also had multi-year weather-related crop shortfalls that went along with all of this. So in the mixture of this, how much of it's due to the rapidly growing demand, how much is due to the fact that we've had major crop shortfalls virtually every year in some part of the world and so forth. So that's been our environment for the last 5 years. If I look ahead and say, well, now what's our environment going forward? Well, the financial crisis is going to play itself out at this point. We're still going to be stuck with sovereign debt and solvency issues. I think in Europe, they're going to plague us for the next 3 or 4 years. You're going to have very subdued growth in the advanced economies, and you're going to have a lot of fiscal austerity. And you can see that in the debate in the U.S. and so forth. All these rampant fiscal deficits are now going to turn into ways to control government spending, to limit government spending and so forth, to bring debt under control. That's going to give us more subdued growth, I think, particularly in the advanced economies. And importantly, remember, these advanced economies are the major markets for China and the others. So when you talk about China, and we talk about 8% growth rates there now, part of that is the fact that if the advanced world is only growing at 2% or less, they're not providing the export markets they provided when they were going full out and stimulating their economies. Liquidity, obviously, the central banks, as we begin to evolve and growth begins to improve in the advanced economies, you've got to expect these central banks to begin reducing liquidity. So we're going to be facing some rising interest rates as we go further into 2015 and so forth. So that'll be a change in the environment. Tempered growth in the emerging markets, as I mentioned, they depend on the advanced economies. They're not going to be growing as fast. I think the middle class is still going to be increasing in numbers. I think that's the positive side for all the commodities and so forth. It isn't that this rising middle class is not going to go away. I just don't think they're going to have the purchasing power that they had the last time around and so forth. So that'll be a little bit more subdued. We also have a new energy paradigm, and I think this is one that agriculture is going to have to watch very carefully going forward. As I mentioned to you, there is this linkage between energy and agriculture and so forth. As we enter this new energy paradigm with regard to fracking and natural gas, and we revisit the role of renewables and the expectations about growth in renewables and so forth, I think, as much as we talk about the Farm Bill, what we do with energy programs is going to be just as important to agriculture going forward. I do expect a peaking in biofuels growth. I think we'll see some delinking from oil as we go forward. How fast that delinking occurs will be a function of what we do with energy policy in this country. But obviously, we're now being talked about North America as the new Saudi Arabia of the world. That's got to change the energy paradigm that we were under over the previous 5 years. Obviously, all of this for agriculture really starts with grain stock rebuilding. It's the catalyst for us finding kind of this new normal at this point in time. So these transitions get underway once we begin to get that grain stock rebuilding, and I'll talk about that a little later. But that's what will begin us down the path, I think, in terms of change. This slide just reinforces the notion of volatility. Even though we talk about a transition period that looks different, perhaps a little bit more subdued from the demand side, and perhaps a little bit bigger on the supply side, we're still going to have a lot of volatility out there. So if you look over the last 4 years from 08 to 2012, the range on corn prices, has been around almost $3. A range on prices high to low in the futures market has been, in that $5 to $6 range, and wheat $4. So this volatility in the risk management side is not going to go away in this new environment as we seek this new normal. I think we're going to continue to have this kind of volatility around some kind of a price level. Obviously, for 2013, for the ag sector, all the focus really is on South America and the 2013 crops in terms of what they promise in the short term as opposed to the long term. I mentioned grain inventories. It's really the driver. As you can see from this slide, this is grain stocks and then stocks to use. Now, I'll just make a point to you that here's the old normal where we're kind of running stocks to use around 25, 26% with inventories around 350 to 400 million tons. You can see where we are today. 350 million tons today gets you a stocks to use ratio of around 20%. So we need to move these stocks up before we're going to find that new normal in the context of the global environment and so forth. So an awful lot depends on starting this process in 2013 with increased grain production. But we remain in a tight situation with regard to total grain inventories. I think Mark already mentioned the drought. It continues to be the thing that hangs over the markets at this point in time. So when you begin to look at this drought map and put it in the context of corn production, you can see it's the western corn belt that really is under the most pressure. Here's Nebraska in the map here that shows you where the major corn producing areas are, and you can see that Nebraska is kind of the bullseye of that. Again, we don't start planting till April. It tells me when I look at this map that we're going to be in one of those timely rain type scenarios and so forth, no matter what happens. We're going to get some moisture. We are getting some moisture. We'll probably have enough moisture to put something in the ground, but we're not going to have enough subsoil moisture to avoid kind of a month-to-month review of timely rains as we go through the season. And that's just going to add to volatility, I think, going forward. Obviously, hay is also an issue, and you can see that there are several of the major hay-producing areas inside the bullseye of this drought area as well. And obviously, we've seen a lot of this in the cattle side, where cattle have been moved into the southeast because of droughts in the southwest and so forth. This is going to be an ongoing issue through these major areas of forage production. You can see that this has really resulted in a fairly significant increase in prices as you go up from December 2010 to December 2012. Forage costs are up about 66%, feed costs are up about 38%, and so forth. So the relief for this is really going to be weather-driven going forward. And, of course, the long-term drought maps that they put out, this is a U.S. seasonal drought outlook. This is really a tendency map for the next 2 or 3 months. And you can see that the forecast is of persistence in drought, some improvement in some areas around the fringes, but the core of the Midwest is still going to be under drought pressures, I think, until we get into April or so. This takes us right to the planting season and so forth. So weather is still going to be a dominating factor, I think, in terms of marketplace adjustments and the kind of volatility we're going to be talking about. Corn is the focus, obviously, at this point in time with regard to setting feed grain prices. It's also the driver that we have for wheat prices as well, in the sense that we are feeding a lot of wheat in the global marketplace, and that gets to be an important issue going forward. You can see corn inventories are down around 600 million bushels, extremely low grain carryover on the corn side. You can see we've had reduced harvest the last 2 or 3 years and so forth. That's led to this drawdown in grain inventories. The rationing process has begun with regard to corn use. Most of the rationing has been on the export side. One of the things that we've witnessed this past year is the animal protein and dairy sectors really are trying to bridge to the 2013-14 harvest. Feed use is only down about 2%, and I think the reason for that is we have had some increases in protein and dairy, in protein prices in particular on the hog and broiler side, I think that supported higher feed use than previously expected and so forth. But I think there's a lot of the animal protein and dairy side really saying, if I can bridge to that next crop, I'm going to get some relief that Mark alluded to if we get a normal harvest and so forth. If we don't get that normal harvest, then we have more adjustments coming, I think. The big numbers on potential planted acres, the comfort that a lot of people are feeling is the expectation is we're going to plant 98 to 99 million acres of corn. We're going to hold 77 million acres in soybeans. This gives us tremendous acreage potential going into the crop, so that the yield requirement that we have, to get to some kind of a balance on the grain side and to add the carryover really is somewhere in that 150 to 160 range. So with all of this acreage and so forth, we don't need the big yield. And this slide just shows you if you've got 98 to 98 million acres planted and you get a yield around 150, you're going to harvest a crop around 13.5 billion. That should allow you to add significantly to carryover and give us some of those price moves that Mark was talking about and so forth. And you can see if we could get to 160, we would add substantially. So these big acreage numbers that are expected really will provide some opportunities to make adjustments on the grain carryover side, even with somewhat reduced yields going forward if we do have some impacts from the drought. On the soybean side, it's all about South America. Will South America increase production by 30 million metric tons this year? The expectations are still strong for that. That would give you significant relief on the protein side in terms of soybean meal in particular. We would begin to see a buildup and carryover of soybeans. We'd still be tight on a stock-to-use basis, but you can see we would build some inventory if South America can come in with that big crop. And so far, that looks favorable and so forth. That would obviously have to be followed up, of course, with a good U.S. crop as well. But I think that would begin the process of realigning some of these prices towards some kind of a new normal and so forth. If we followed up with a big U.S. corn crop and a big U.S. soybean crop, we begin to be talking about a different kind of price level and so forth. Clearly, the gap between where prices for livestock are and where prices for crops are at this point in time is not sustainable. You can see this big gap between prices received by livestock and dairy and prices received by the crop sector in terms of the red. That gap is simply not sustainable at current levels. We either have to have higher meat and dairy prices or lower grain prices to close that gap. I think at this point in time, both sectors are going to be operating at a higher price and cost level. We're going to have more working capital to play in this environment. We're going to bring these prices down perhaps a little bit with a big crop, but the reality is it's probably going to take a couple of good years of production really to find a new normal and so forth. In the meantime, there's still going to be a lot of volatility. I think that's going to be a challenge for both sectors of the economy going forward. Let me stop there and join Mark in responding to kind of any questions that people might have with regard to this outlook.
All righty. Well, thank you very much, Terry. Nice job again on that, and a lot of perspective between both presentations for all of us to think about and learn from. So really appreciate that. I'm going to give Mark the first question, but before I do that, I'm going to ask Kate, who just sent in a question, but the question didn't come with your text. So if there was something you wanted to ask, just retext that to me, please. You sent something in at 10:43. So first question to Mark. Can you explain in further detail why cheese prices dropped recently?
Mark, are you there?
Okay, there.
There you go. Thank you.
Can I explain further why cheese price dropped? Is that the question, Jim?
That's correct, Mark.
Well, again, I think the reason that the cheese prices dropped is that we are selling product overseas. We had gotten out of alignment with that, and those sales that were committed to exports, if we didn't sell them at a competitive price would have come back onto our domestic markets and would have pushed our domestic prices down anyway. So we are being moved back into a better alignment with those world prices. As long as we're selling in those marketplaces, we can't have prices that are grossly out of alignment with others. In general, U.S. prices are selling somewhat at a discount to what Oceania prices are, but not too much.
Okay, thanks, Mark. Next question goes to Terry. You didn't talk much about ethanol this time, and any time in the last half a dozen or so years we've had this kind of discussion, there would have been quite a bit of mention of ethanol. So what's your view on where that fits into the fundamentals of corn markets and maybe what the outlook is there, Terry?
Well, yeah, and again, time doesn't permit us to dig into all of these details and so forth. If you remember from that slide on usage of corn, ethanol was down about 10%. My expectation is that ethanol is still going to be a significant factor in the corn market. I do not think it's going to be a major growth factor going forward. As I mentioned, energy policy is going to have a lot to do with what happens with ethanol. We've got the E85 and the blend wall issues and so forth. My real expectation is that ethanol is going to grow a little bit more in terms of corn consumption, but I expect it to kind of stay capped out at that 15 billion gallon level and so forth. So I think it's still going to be a player in the market, but I don't think it's going to be the absorber of production that it has been over the last 5 or 6 years. It was increasing on the order of 600 to 800 million bushels of usage per year over the last 4 or 5 years. My expectation is that you're going to see a flattening out in terms of growth in corn consumption on the ethanol side. And as we increase production, what that's mean is going to be more grain available for the other sectors in terms of the feed and the export side. So I think that's where it's going. Ethanol is going to remain a viable player in the marketplace. Its profitability obviously driven by where we go with oil prices as much as corn prices and so forth. So it's still a factor, but I don't think it's a growth factor that has been over the last 5 years.
All right, thank you, Terry. Next question I'm going to give to both of you because it's kind of an interesting one across the board, not just dairy. But in regards to the economy, how much impact do you think the average American getting $1,000 less in their paycheck is going to affect their consumption of food/dairy products? And Mark, why don't you go first and Terry second?
Well, I don't think it's going to have a big impact on dairy consumption domestically, but it will have some impact. And, the first place that you'd expect that kind of impact to be shown would be in out-of-home eating. And that does have an impact for sure. It does shift the consumption categories a little bit. But again, I think that mostly $1,000 to $2,000 out of a typical salary is going to be important income stream, but it's likely going to be hitting much of the luxury consumption in the homes, not so much the food consumption.
Well, yeah, I would agree with Mark on that one. I think one also has to put in the context that, oil prices have fallen down, so gasoline's off a little bit. It's been a warmer than normal winter, and particularly in the east and so forth, and those factors probably have reduced utility bills and so forth. So at the end of the day, I would agree. Obviously this hits a lot of folks with a high propensity to spend and so forth in terms of the lower income. I don't think it's going to show up a great deal in the basic food items. It could show up a little bit perhaps in the protein side and away from home, but we've got some other factors that may be offsetting in terms of not making that $1,000 out of pocket totally felt. If you're getting some breaks on energy costs and utility costs and so forth, that does mitigate some of those impacts.
Okay, I'm going to move to the next question, and I think it'll go to Terry, and if Mark would like to comment, we'll certainly welcome that. Please explain the decoupling of corn prices from oil prices.
Well, again, this relates to the fact that if how much further is renewable fuels going to grow in the future and so forth, and if that number is going to top out, depending on what we do with biodiesel policy in terms of soy oil and so forth, to the degree that we don't provide the stimulus to those sectors of the economy that we have over the last 4 or 5 years, what's going to happen is that these commodity prices are going to be more driven by the fundamentals in the export market and the feed market and so forth, as opposed to what's happening in the energy market and so forth. So what I alluded to was those sectors are not going to go away, but if they're not the growth sectors, if they become kind of the stagnant sectors and so forth, then the drivers for the marketplace suddenly become global demand for grain, domestic demand for grain in terms of food use and animal use and so forth. And so that's that delinking process that could occur as we go forward, as we make shifts in depending what we do with energy policy. And again, that's the real wild card at this point in time. Do we do something about the blend wall? Do we move to E85? There's a lot of differences of opinion in terms of where we might be going, but my expectation is that given what we see in terms of North America becoming the new Saudi Arabia, it would have to argue to me that we will be delinking a bit as we scale back perhaps on our incentives to renewables. We will be delinking the ag commodities a little bit from the oil prices.
Okay, Mark, add anything?
Well, I would just say I agree with Terry. I mean, the gas exploration and new methods for harvesting that have given us just tremendous reserves. The real issue, I think, is this transition time period is that it's in a different form factor than the ethanol is providing. Ethanol is something that we can put in our cars relatively easily. Propane or natural gas, not so much. But they will be transferring those energy uses, and they will find some new equilibrium. It just takes a while before it becomes more delinked.
Okay, going to move on. Next question, Terry. With more acres likely to be planted this year and a bit of back to the drawing board on the Farm Bill, will conservation programs resurface more seriously as a break to future benefits, in particular crop insurance?
Well, yeah, I think if you look at the progress that was made on the Farm Bill and so forth, you could see the transition where we're going to be moving away from direct payments, maybe perhaps not for the cotton and rice folks, but certainly for the traditional Midwestern crops and so forth. We're going to be moving more towards revenue and crop insurance programs away from direct payments and so forth. The conservation side will be a bit of a challenge because even with these acreages that we're talking about, my guess is that we'll still be scaling back a little bit on conservation programs. We've already made some cuts in some of those conservation programs. I would expect there will be some cuts when the new Farm Bill is done. So my expectation is the insurance programs will be a significant driver in the Farm Bill, and how they're structured is going to continue to change.
Okay, next question for Mark. You showed a chart, net income over feed costs. Does that include only milk income, or would it include the cull and calf sales income?
Good question. It was only milk income, but it was an all milk income, and it was an income over the standardized ration for feed costs.
Okay, next question. I think this refers to one of Terry's slides, but I'll start with him, and then if we've got the wrong speaker, we can move to Mark. But what brought about the new plateau in prices in the early 1970s? Well,
in the 1970s, that was the if you recall, that was the emergence of new markets overseas. That was really an export-driven new normal and so forth more than anything else. So it was really kind of an awakening on the export movements as much as anything else, particularly in the early 70s and so forth. It finally gave way under pressure from expanded production in other parts of the world. But I think for a time, when we got to that new normal, we really found, particularly for the U.S. in particular, it was just a rapid expansion in demand that led to very sharp increases in export markets and lifted consumption globally and so forth. That's what lifted us to that new normal, and there are some parallels to what we saw in terms of the emerging markets in the 2006 period, where we went to the transition and so forth, where you kind of lifted up a whole nother class of consumer and so forth. So a very similar type of a driver there, a little bit different obviously because we had ethanol, we had renewable energy playing a role in addition to the expansion with regard to the emerging markets and so forth. So we had a little double catalyst in the current transition. The previous transition was much more driven simply by global demand for grain that led to very strong export markets, and then eventually, of course, global production caught up with that new demand, and we found that new normal and so forth. Obviously, we also had some significant increases in energy prices at that point in time. They were also a factor through that period.
Okay, I'm going to move on, give the next one to Mark, and clearly a question that a lot of us who work in New York State are thinking about, and it goes as follows. Where do you see the supply and demand of milk going in 2013, considering the large growth of Chobani in New York and Idaho, along with the 2 new yogurt factories in western New York? Are we really in a milk deficit, and how is that projected to reflect in our 2013 prices?
Well, those are good questions. New York is going to be increasing milk production, and the region in general a bit. But I think that there are some real barriers to rapid or dramatic increases in milk production that can happen out there unless you have prices that are just sufficient to provide enough lift to input costs and purchasing more inputs. I think the greater likelihood is that you're going to see modest, sustained growth, and the new demand for milk for some of these products, the Greek yogurts and things, are going to be able to outpay milk supplies from more commodity-oriented products. In particular, I think about the mozzarella plants in the Northeast that are likely to give up their milk or have to give up at least a portion of their milk to the yogurt operations. If that's the case, then those plant capacities for mozzarella are going to have to look in other parts of the country for it. So, some support to prices, some growth in milk supplies, but I don't think you can provide everything that all of the existing plants and the new plants need.
Okay, I'm going to do one last question here, and apologize to those of you who I've overlooked here, but I want to keep us on time today. So I think this is a good question for both of the speakers. I'll start with Terry and let Mark do wrap up. How will the value of the dollar affect the outlook for 2013? Terry, what do you think?
Well, I mean, the dollar's appreciated, 6% over the last year and a half and so forth, really against the European and Japanese currencies and so forth. Against the other Asian currencies like China, the dollar continues to slide a little bit weaker and so forth. I don't think it's going to make major shifts in terms of the markets that we're going to be shipping to, particularly the emerging Asia markets and so forth. There, I think the dollar is going to remain in a steady to weaker position, which will be favorable for the export side. I think the big moves in terms of Europe, the euro, and the yen, they're not going to have a significant impact and so forth, but it does depend on the market you're going into. But I don't think it's a game changer this year in terms of the marketplace.
I'd agree with Terry. Yeah, I would agree with Terry. The export markets for dairy, the #1 market is Mexico, Number 2 market is Canada, and after that we have a number of Asian markets. And against those particular countries, the value of the U.S. dollar has actually been in decline, not strengthening, as Terry mentioned, and I think it still bodes well for us in export markets.
Okay, very good. I hate to do it because there's several more good questions, but I am going to move ahead to a panel discussion here. And before I introduce the 2 speakers for that, and by the way, again, a big thank you to Mark and Terry. You both have done a great job of giving us a nice, crisp, insightful analysis of your view on 2013. We really appreciate having you on board with us this morning, so thank you. So the first question to my 2 panelists is to really reflect on what the 2 prior speakers have talked about, and just give us 1 or 2 takeaways that kind of struck you from these talks, and then we'll go to some other questions as well. So I'd like to introduce you to Mandy Minnick. She is Senior Vice President with the Agribusiness Group of Northwest Farm Credit Services based in Spokane, Washington. And we at Farm Credit East are very proud of our relationship with Northwest Farm Credit. We work with them very closely on a whole range of things. They're great partners. And one of the things is we can always talk shop and learn something from each other because, for example, their dairy industry looks a lot different than our industry here in the Northeast. Mark got into that a little bit. And so we do talk shop from time to time, and so we thought it would be helpful to have Mandy as one of our panelists this morning. So good morning, Mandy. Our other panelist will be Gary Snyder. And Gary is our senior business consultant here at Farm Credit East. I won't tell you how long he's been in that role, but he's very veteran, very knowledgeable, consults with many of the best dairy farms in New York State. Not all of them, but sometimes you wonder, there's a trail of dust behind Gary's car, and he cuts a pretty big path across New York State and maybe a little bit further. And I could tell you a lot of things about Gary, but every time I talk to him, I learn something new. He's got a unique insight, or he's got an idea that he wants to play off of, and so he's just got tremendous insight into this industry, as well as the ability to work hands-on with individual dairy producers in helping them be successful. So those are our next 2 speakers. So Mandy, 1 or 2 things out of the previous 2 speakers that would be takeaways for you.
Thanks, Jim. Yeah, as I listen to Mark and Terry, I agree and acknowledge much of what they said. I think that the 2 takeaways that I see and that I hear also echoed with our producers is volatility, that it's here to stay, and that we've got to figure out some way to be prepared for that, and controlling those feed prices, especially in times of high feed, is really about your best ability to maintain profitability, and finding a way to control those feed costs without adding too much overhead as you go. So if you're out buying land, trying to buy land that you can add to your portfolio without locking in high feed costs, and having the ability to cash flow those until that feed production is a benefit to the bottom line of the dairy farm, are really the challenges that we have going forward. And in our area here, in the western part of the United States, there's a lot of competition for that farm ground with other high-value crops, sugar beets, potatoes, things like that. And so making these long-term decisions is not only difficult from a financial feasibility outlook, but also finding that ground and being able to secure it. So I think that theme of volatility and controlling feed costs are my two biggest takeaways from the presentation.
Okay, thanks, Mandy. Gary, a couple takeaways.
I found a special interest in the chart that Mark put up there comparing Western dairy cost structures to what he called the more traditional cost structures, and identifying the remarkable difference between the variable expenses and the overhead expenses in each particular region. The dairy economics have certainly changed, and there was another pretty profound statement that Mark indicated that we would have been much worse off if we'd had a price problem at the moment than a high feed cost problem. And it kind of brings us back to the counseling that we do with our farm businesses, in that each business manager has to be able to recognize what their competitive advantage is. And then with those cost structures that Mark shared with us, there's a lot of insight there and an opportunity for us to identify strengths and weaknesses that exist within a particular business. We'll generally recommend to our clients, of course, that they monitor their earnings and their cost structure, and there's great opportunity there, I think, for us in the future to help people identify what their costs are and how competitive they are in that cost structure.
Okay, Gary, that's a nice segue to my next question, and I'm going to keep going in the same order rather than try to, reverse order here or anything. So we'll start with Mandy and go back to Gary. But, one of the things that we've really observed here at Farm Credit East in the last few years with all of these kind of random shocks coming at farm business people is that the speed with which producers react and respond and kind of readjust their business model is really critical. And we see sometimes, literally within a month or two, some producers beginning to take actions, and we'll see other producers that might take a year or more before they make much change to their business operation. And with all this volatility, it really is critical. So my question is to both of you, what sorts of adjustments did you see progressive producers making to these shocks that we've talked about in 2012? Mandy, with your group there in Idaho and other parts of the Northwest, what sorts of adjustments did you see?
Here in our area, so we have, using Mark's terminology, Idaho would be sort of that Western model, and then in in Washington, both Western and Eastern, a little bit more of that traditional model of owning more of your feed supply. So I think as far as some of the things that we saw people do to try to manage that volatility, try to become as lean as they could, get rid of any non-producing income assets that they had that were costing them, try to really button up that feed supply cost in any way that they could. Maybe that meant going out and making an alliance with a neighbor farmer if you didn't have a lot of your own ground, trying to secure additional ground. As I said, though, making sure that you don't overpay so you're not locking in long-term costs that are high for that feed. We saw, some change in the way that people how they carried their heifer programs. There was a comment made earlier about, is that heifer, what's she going to be worth by the time you put $1,800 or $1,900 into her to raise her? What kind of income can she produce? And then I'm glad to see too that we've seen some deleveraging over time and some some dairymen starting to really understand the value of being liquid, because in the dairy industry that's so capital-based, it's really hard to make fast changes, and liquidity and having some cash on hand and deleveraging has been a very good tool in doing that.
Thanks, Mandy. And Gary, what sorts of adjustments did you see your progressive producers making during the year?
There's no question about it that these are volatile times. And if we step back and we think of the definition of volatility, it's a rapid change in things that are taking place. And we saw some rapid changes in the most successful businesses in 2012. And a number of those people did something that we call practicing cost avoidance. They did a better job of allocating scarce resources, forage that they grew, expensive grain that they bought, and basically there was a major shift in what I call production unit economics, in that progressive dairy farmers were able to sit down and they looked at every cow, if you will, as a cost or a profit center. And there was a high degree of voluntary culling, a cleaning out of the dairy herd, and folks actually increased earnings by making sure that they had marketed, sold, liquidated the unproductive assets, those cows that either were using up scarce resources or actually costing the farmer money. So there was a really tightening up of the dairy herd. We have a better herd of cows, generally speaking, in the Northeast today than we had a year ago. And this volatility, these scarce resources, and identifying just what profitability we had per unit made these people better managers.
Okay, just to follow up, Gary, so you threw out a new term, cost avoidance. What's the difference between cost avoidance and cost control?
Well, cost avoidance is if basically we'll use the cow as the example. If I'm not going to buy feed for that cow, that's cost avoidance. I got rid of the cow. I avoided the certainly all of the variable expenses that were associated with that cow. The cost control, I think of as maybe a better allocation or cutting back. Cost avoidance is more than cutting back. It's not having the cost in the first place.
Next question to both of you. So as you begin to sit down with producers and have discussions about 2013, Gary, I know you're doing a lot of budgeting and planning with your clients as we speak, and I suspect the same thing is going on in the Northwest in terms of planning for credit needs. One or two pieces of advice that you're giving your producers that we haven't already talked about, but one or two things that you would advise producers to be thinking and planning about in 2013. What do you got, Mandy?
Something that we haven't already talked about. I just think that having some liquidity in your operation to be able to react quickly, and then also having a short-term and a long-term plan for paying down debt and keeping that leverage under control, so that if another 2009 comes along, you're in a financial position to be able to withstand that downturn. The folks that we have seen that continue to really struggle are those that are still dealing with some of that carryover debt from 2009 and have struggled to come back into a profitable operating situation. So you know, just trying to shed as much debt as you possibly can, and being liquid for that next downturn, so you're ready whenever that comes.
All right, very good. Gary, what have you got in your advice for producers this year?
Our advice is through analysis, actually through the numbers, through measuring performance, monitoring the business with facts. Then what we need to do is that we need to make sure that we allocate these scarce resources to the areas that are going to give us the greatest return. We sit down through analysis and identify what our competitive advantage is. If we can't find, if that is a short list, then we need to be working on a strategy of our business to really accomplish a competitive advantage that we have that many others do not have. We need to be able to control the controllables. And we're encouraging people to enlist the key people in their business, the advisors to those businesses, to actually sit down and develop action plans to enhance, capitalize, and then improve our competitive position.
I'm going to reflect on that answer, but I'm going to give you both the last question, and then we're going to move on. And so I'm going to ask both of you, and something that we get asked a lot at customer meetings. Given the general economic outlook here, and, you know, we've all read that the Federal Reserve is going to keep interest rates low for at least another year. But how would you advise producers to be managing the liabilities portion of their balance sheet? Again, we'll start with Mandy and finish up with Gary. But while you're thinking of an answer for that, Gary, back to your comment, and this is really a Farm Credit East commercial, but geez, the good old days of being able to manage your business from last year's tax return, your DHIA monthly records, and what's left over in your checking account, that's long gone. And I think we see the producers that are really on top of these changes have got good real-time monthly accounting data, and they're using it effectively. Did I get that about right, Gary?
I think you got it perfect. That's exactly true. You know, we talk about volatility. Mandy mentioned it, Mark mentioned it, Terry mentioned it. This volatility, these rapid changes, things can get out of control really quickly. And you've got to have real-time data. You have to have the ability to monitor in real time changes that are taking place in the business, because a lot of money can slip through our fingers in a very short period of time. Being the lowest cost producer, or being one of the lowest cost producers in a commodity market like we have in dairy, is perhaps our best risk management plan that we can come up with. And I liked what Mandy said about building cash reserves, or perhaps replenishing our borrowing capacity, because we know that these cycles will continue, the volatility will remain, and we certainly need to maintain flexibility in our businesses.
Okay, Mandy, wrap-up comment. What would your thoughts be on managing the liabilities portion of the balance sheet this year? Is it a good time for producers to be thinking about converting from variable rate pricing to fixed rate pricing, or maybe continue to ride with those variable rates, which are incredibly attractive right now? Any other thoughts about managing the liabilities?
I guess I just go back to, try to get that liquidity up, which means paying down those short-term liabilities. If you've got any of those carryover liabilities, which are past losses, and you don't think you're going to be able to get rid of those, that might be something to look at, trying to get on more of a fixed than a variable, so at least you have that part taken care of. I guess I'm pretty conservative, so when I look at long-term purchases, long-term rates are so good that I would have a hard time not encouraging somebody if they wanted to make a long-term land or real estate purchase, not to lock those in, but to just make sure that when you're making those kind of additions to your balance sheet asset-wise, that you're really doing that cost analysis and making sure that in the long run you're helping out your operation by locking in reasonable feed costs, not doing it at the top of the market cost because perhaps the farm next door is available to you or those kind of things. So just, every decision that you make, you just really need to make sure that if it makes sense today, that it makes sense for the long-term viability of your operation as well.
Mandy, thank you so much for joining us today. We really value your perspective, and you're starting the day early since you're on Pacific time. Really appreciate your participating.
Thank you, Jim. I appreciate it as well.
And Gary, what would you be advising your clients in terms of managing the liabilities portion of the balance sheet?
I think making sure that all of the capital investments that we are considering, setting a priority, a hierarchy, if you will, of investing in those items that give us the best return, the best payback. I think always budgeting gives us the opportunity of a preview, a sneak preview, if you will, of how things are probably going to turn out. And so I would continue to be doing a number of what-if scenarios and developing then a strategy of operating the business to go with those.
All right. Well, thank you, Gary, as usual, for a lot of good insight and practical advice. We really appreciate your participation this morning and the work you do with producers as part of your job. So thank you both. Yeah, I would chime on before we go to the next section. We at Farm Credit East would advise our customers understand the impact of variable versus fixed rate. We're not in the business of projecting interest rates. We're no better at that than pretty much everybody else. But make an informed decision as to how much of your debt you go variable and how much you might fix, and our staff can help you do that, explain the options and so forth. But it ought to be an informed decision as opposed to kind of a knee-jerk decision based on current attractiveness of variable rates. So with that, I want to move on to our next speaker. His name is Craig Rigelbrugge, and he is an expert on agricultural labor and immigration reform, somebody that we have worked with over many years as agriculture has dealt with this very challenging issue of access to having sufficient labor to be able to get the job done, quite frankly. He's co-chair of the Agricultural Coalition for Immigration Reform, serves on the steering committee of the Essential Worker Immigration Coalition, which is the leading coalition seeking legislative reform of America's antiquated immigration system. He was recently elected vice chairman of the board of the National Immigration Forum. I think Craig also has a day job in addition to all of this, and he is vice president for government relations with the American Nursery and Landscape Association in Washington. In his position, Craig oversees ANLA's government relations program and relationships with national, regional, and state green industry groups. So with that, I'd like to invite Craig to take the microphone and talk a little bit about farm labor issues.
Great, thanks very much, and I really appreciate the opportunity to be with you all. Let me just ask our organizers, are the slides showing properly?
Yep, they look good.
Perfect, thanks. I would be remiss if I didn't start by thanking Farm Credit East. You've really been the leader in the nation in the entire farm credit system in terms of seeing the importance of the farm labor issue, having it as a policy priority, helping to develop data products that have helped us collectively make the case to lawmakers about the economic implications of solving the problem or not solving the problem. And, you know, we're attempting to replicate the successful relationship that we've enjoyed with you all for a long, long time with other farm credit entities around the country. You've really been the national leader, and I just want to thank you for that, and you know, particularly Bob Smith, but also others. We've really appreciated the chance to work side by side with you on the issue. So let's take a quick tour of sort of where we are on the issue, and is there any hope? And I guess a fair question would be where to start. This has been a marathon, not a sprint, and there's a number of places to start. But I guess the place I'll start is to say let's just be thankful we're even here. To turn the clock back just about a month, and the Mayan calendar was predicting the end of the world. Fortunately, the Mayan calendar turned out to be wrong, and the Oreo cookie turned out to be right, and hopefully you see the graphic there, but the Oreo cookie tells us not to worry, and sure enough, the Oreo was right, and life goes on. So what do we have? I think a good place to start, other than the Mayan calendar, is the November 6th election, and the way I would characterize the environment we're in is it's really a tale of two realities. One of them is November 6th changed everything, the other is November 6th changed virtually nothing. On the everything side, this was really the first election, the first national election, where it is pretty much indisputable that the nation's largest and fastest growing minority, that being Hispanic voters, made a significant difference in certain geographies. Certainly in a handful of states, including places like Florida, Colorado, Nevada, and perhaps even a few others, the Hispanic vote was perhaps decisive in the presidential race, and certainly in statewide races. This was really the first election where we saw the Hispanic vote block, if you will, flexing its muscle. Candidate Romney, for his part, tanked among Hispanics. Depending on whose numbers you believe, he got somewhere between 27 and 29% of the Hispanic vote. His own advisors felt they needed to get 35% in order to have a fighting chance. He fell short of that. It was a pretty dismal performance, and it immediately led to a round of soul-searching criticisms for that fateful Republican primary debate night in Florida, when Rick Perry allowed as to how if you don't have a little bit of concern about the plight of young people who have grown up here without proper immigration status, you probably don't have a heart. And Romney outflanked him on the right on this issue. That was the beginning of the end in a lot of people's postmortems. Demographics are destiny, and the challenges facing Republicans are only going to grow electorally speaking. Not so much with safe House of Representatives congressional districts, but certainly with statewide races in states where there's a growing immigrant population, including significantly Hispanics, but also certainly in national races. So the soul searching is going on. I think Senator Marco Rubio of Florida said it very well when he said Hispanic voters care about the same issues as a lot of other voters. They care about things like jobs and economic wellness and education and whatnot, but it's hard to have a conversation on those issues where Republicans can probably speak to Hispanic voters when they're afraid you're going to deport their grandmother. So anyway, lots of soul searching. That's part of the changed everything master narrative. The changed nothing master narrative is, well, guess what? Same old, same old. We got the same president. We've got the same Senate Majority Leader, Senate Minority Leader, House Speaker, House Majority Leader, House Minority Leader, and only a handful of seats changed. Dems picked up a couple of seats in the Senate and a couple of more seats in the House, but fundamentally the margins of control are about the same. So we're really, in some respects, dealing with the same challenges. Now, in my opinion, I'm coming down on the positive side. So if you force me to choose one of those two master narratives, I'm going to change the I'm going to choose the it changed everything, or at least it gives us a fresh opening and an opportunity to try to move this issue forward. So that's where we're going to spend the most of our energy. So stated differently, I'm a glass half full guy, having been on the battlefield for a long time on this issue, and I think the last time that we had odds of something actually happening that approached or exceeded 50% was probably 2007, when President Bush put his shoulder to the wheel. 06, of course, the Senate passed a bill. It had our ag provisions in it. House chose to thumb its nose at that. 07, President got behind things. We didn't quite clear the Senate collectively. We are now approaching, I think, the next time where our odds, if you're an odds type person, approach or maybe slightly exceed 50%, but a long distance between here and there. So as the glass half full, I think both parties have reasons to deal with repairing the system. For Republicans, it's get this issue in the rearview mirror and redefine the terms of engagement on issues where Republicans can appeal to values and policy specifics that appeal to immigrant voters and so forth. For Democrats, okay, they've been given a chance, but everyone's watching closely, and some Democrats are prone to playing politics with this issue, and they'll be called on it. And so there are downsides for Democrats not delivering. For his part, President Obama has basically said this is top priority once the fiscal and tax-related issues are pretty much cleared out of the way. Unfortunately, they're not yet completely. And I think another positive is that some strong former antagonists, ranging from Lou Dobbs to Sean Hannity, have changed their tune, and they've now come out saying we need to do something. We still have our traditional anti-immigrant antagonists who are going to fight us tooth and nail, but these folks had big microphones, and having them neutral to positive with respect to dealing with the issue is a very, very helpful thing. I think there's one other, I didn't put it in my slide, but I think there's one other atmospheric which is helpful to us, and that is the news that net migration from Mexico is believed to have fallen to about zero, or potentially even slightly negative, but probably about zero. What better time? I mean, if you're repairing the bridge into the city, do you do it during rush hour or do you do it during the middle of the night? Of course, you try to do it during the middle of the night. And what better opportunity to retool and repair what has become a creaky immigration system than to build the capacity to allow for economic migration that's in our interest at a time when we're not being overrun with a large amount of quote, illegal immigration across the southern border. Okay, I mentioned there's two caveats. What are they? Well, the first is fiscal stuff, and of course, as you all know, the solution, the partial solution that we got right as the new year was beginning, debate right around, and mood is a risk. The second one, obviously, nobody saw this one coming until the Connecticut shooter did what he did. But the gun debate and the possibility of a gun debate, at least in the Senate, maybe beyond, it's the same committees of jurisdiction as immigration. It is potentially a politically very, very divisive and distracting issue, however you feel about it personally. So it's there, and we're going to just have to weather it and live through it however it shakes out. I think we'd like to mention next, with respect to major efforts in agriculture, we have been working double time for about the last 9 months to try to reunify an industry which has become pretty fractured over the years. It wasn't always that way. There was a time, 2003, 2004, where ag was pretty much all working together. There were a few outliers, but fundamentally ag was working together. Unfortunately, as the years went on and the debate got worse, we became a house divided, and as I believe Mr. Lincoln said, a house divided cannot stand. The problem with a divided agriculture is it lets lawmakers who know they need to do something, it lets them off the hook. They basically say, well, you know, and until you all get together and agree on what you can live with, why would I put my head up? So we have to present a united front to Congress. Toward that end, there's a new sort of superstructure that's been established. I want people to understand, you know, why do we need another group? What is the purpose of this group? there's been a new group launched as of the end of last week called the Ag Workforce Coalition. It is basically a DC-focused, Congress-focused superstructure or umbrella that allows the major interests in ag to all come together under that umbrella and project a single voice. Our coalition in the ACIR includes several hundred organizations around the country, national, regional, and state, whose members are totally dependent on farm labor. They're in those sectors of ag that need labor, including a lot of dairy, particularly the regional dairy groups and co-ops in the Northeast, Southeast, Mid-Atlantic, Upper Midwest, and West. But then you have this other entity called the American Farm Bureau Federation, which is the nation's largest general farm organization. It is essential that we, NAFBF, are projecting a compatible voice, and that's why this superstructure has been created. It's being administered by the National Council of Farmer Cooperatives, which itself has a major stake in the dairy industry and the dairy co-op structure. NCFC is, in my humble view, kind of seen as Switzerland. They're seen as a good neutral party, so they've taken on the administrative responsibility for that effort. The primary roles for this AWC, as I say, it's to present a unified front to Congress, and I think a secondary but also important purpose is to try to reach out and engage peripheral groups that haven't been with the fruit, vegetable, dairy, livestock, nursery, greenhouse industries. We've been at the core of this thing, and there are a lot of other groups in the meat industry, food processing, things that are related to ag that need to know what we're up to, and they have some energy to bring. You know, we might be their supply chain, or maybe there's more synergy than that, but a lot of these groups, this has been, you know, even the commodity groups, corn and soybeans and whatnot, this has been on the periphery. And so AWC is trying to loop them in, make sure they're in the know, and that they can be helpful going forward. From our perspective, the good news is we're very well represented in the process. Most of the entities sitting around the table under this AWC superstructure are ACRE Executive Committee members, diverse group of them. Our lawyers, who are the best in the business, are very much involved in the process, and so you know, AWC is not looking to raise money. They're not looking to duplicate the efforts that other groups are doing with respect to grassroots. So we're going to continue to sustain our coalition effort toward the broader good. Now, what's the framework for reform? I have to be clear with you that the framework we have put forward now under the AWC banner is a grower or producer's, you know, preferred, I won't quite call it dream, but if we could kind of have everything the way we want it, this is what we're putting forth. And that is not ultimately politically realistic. It's going to have to change some. There will have to be some points of compromise on a few of the more contentious issues in order to get to bipartisanship and in order to get to something that the farm worker advocate community, chiefly represented by the United Farm Workers Union, can be supportive of. When you look at the politics we're dealing with, if the farm worker advocates, you know, have a machete out for what it is we're proposing, it isn't going to happen. It isn't going to be signed into law by this president. It isn't probably going to clear this Senate. And so we have to have bipartisanship and the support of farm worker advocates. But that said, basically our goals go like this. We'd like to see a new program for the future, different from H-2A. There is a collective sense out there that the H-2A structure is too flawed to repair, that the Department of Labor ignores the statute and the regulations anyway. And so we need a new structure. The application process would be removed out of labor. It would go to, preferably in our view, USDA. Labor's role would be limited to like wage and hour enforcement and whatnot. The future program would have two options for employers. Some employers, and for that matter workers, would prefer a contract option where they're promising a certain amount of work, and the worker is, you know, basically, you know, there's a tie between the employer and the worker subject to a contract. There are industries and geographies where that certainty is needed. For much of the industry, a portable visa option where a worker comes in with an initial job offer, but then can continue to, you know, stay and work with one employer for the life of their visa, or, you know, could move on and move among employers with more flexibility and less bureaucracy than we have in the current H-2A structure. That portable visa option is also important to agriculture, and so we're looking to have both. They meet different needs. We would generally like to see U.S. labor standards apply. There are a few points, such as wages, where that's going to be tricky. I don't think any of us presumes that a foreign worker program will be structured around minimum wage being all you have to pay. Dairy needs are foremost in our minds. Want to be clear that our goals are to have a multi-year visa for dairy, which would at least allow for a future worker to come in for 3 years at a time. They may have to leave the country for a brief period, a certain number of accumulated days every 3 years, but fundamentally we want a long-term visa for the year-round work such as exists in dairy. That's the future. The bridge to the future, we need a way to retain our experienced workforce. It's essential. If we lose the current workforce, the logistics of replacing them and doing the training and developing the experience and getting them here, getting them through the border infrastructure, it just doesn't work. We have to have something like a work and travel visa in the hands of our current workers who can pass a background check and make a future commitment to our industry. This is particularly important because the sending countries, Mexico is the biggest. Central America plays a role, some of the countries in Central America, but Mexico is the primary sending region, and as their economy develops and as their birth rate falls, which it is, they will be sending fewer and fewer workers even with a legal program. So we need to find ways to incentivize the current workers to stay here. They also represent our career ladder, so their skills are essential. So what we're proposing there is essentially a 5-year ag card, which is analogous to the blue card program that existed in ag jobs. We can be flexible on the details of what happens long term. Do all or some of these people end up being able to pursue legal permanent residency? Might some of them someday become citizens subject to conditions? Many of them we know don't have that aspiration. We can be flexible on those details and allow the politics of the Congress to resolve those details. I think another important point there, if we are not flexible on those details and we pigeonhole sort of what works for the ag workers and then we're inside a broader bill, if a legalization structure in a broader bill is more generous than ours, we've got a problem because farm workers won't choose our path. We need to have, farm workers have to get an incrementally better opportunity with incentives to stay in ag. So a couple of quick thoughts on the winding, twisty, hilly, difficult road ahead. The way it looks in Congress right now, we expect the Senate to move first. There is a gang of 8, 4 Republicans and 4 Democrats who are said to be working on a bill. We've touched base with a lot of them. I think the progress is a little slow, but more or less they're working together and making progress. Senator Schumer from New York is one of the gang of 8. And he has basically gone to Senator Feinstein from California and said, Diane, you do the ag piece. One of the things we've needed for a long time, and folks, one takeaway from this call, we need to have a little moment of like a group cheer, a group celebration. We have been looking for Senate Republican leadership for a long time, and we finally now have that. Senator Marco Rubio from Florida has decided that the ag piece is one of his priorities. So he is now in our negotiations with Feinstein. And a Feinstein-Rubio team is a pretty formidable thing, so that's something to celebrate. The Senate, again, guns and debt notwithstanding, we're hoping a debate gets on pretty quickly. The period between now and, say, May or the beginning of June is going to be very critical. Picture is more uncertain in the House. Speaker Boehner's job, makes herding cats look easy, I think. And but it is clear that there is a greater sense among House Republicans that they got to deal with this, that they must deal with this issue. One scenario, there are multiple, but one scenario is that the House actually, moves a little bit after the Senate, but moves a much smaller and more acceptable bill, and then the two are conferenced, and you end up with adults in the room deciding what the conference report looks like, and then there's a final up or down vote. Frankly, between us, that final up or down vote might look a lot like the tax deal at the end of the thing, where Speaker Boehner can't deliver a majority of his own caucus, but they move on and with enough Democrats pass a bill. Administration, the path that we seem to be on is that the administration provides us with principles but not a bill. Actually, having an administration bill would probably be a negative in my view. How you can help, this process going forward is going to be a momentum thing. It is anything that you can be doing as an individual business, doing your political outreach to your own lawmakers, and as a community to help to pile on the momentum is going to be very important. Toward that end, Bob Smith had crafted an ag sign-on letter which calls for what ag needs it is specific enough without being mired down in the details or the weeds. So I think the letter has hit just the right tone and just the right ask, and it is being circulated among ag groups throughout the Northeast right now with the deadline, I believe, of January 25th. So that's a tremendous effort, very important, very, very well timed. We've got newbies in Congress. I think you have to work out to educate them to the extent that you can't yet ask for a specific bill. We need S 3428 or whatever. You need to speak to the need, articulate the need, articulate the economics. Again, Farm Credit has produced a lot of policy pieces that help frame those economics. And because of the fact that all politics are local, you really need to be taking the time and making it your business to do that. I want to just touch on some other collaborations extremely briefly. One of the exciting things for those of us working in this space is that we've got some new allies. And among those new allies are a pretty diverse assemblage of evangelical groups, including a lot of very conservative Christian evangelical churches around the country, who have decided to go back and look at the Bible, and they have found inspiration in the Bible for the right answer here. And they are mobilizing and doing a lot of things that I think will help create, some cover for a reasonable solution on this issue. Now, why is that important? You take a quick look at this map I've put up. It shows that the darker the blue, the more increase in foreign-born population in the state between 2000 and 2010, so basically over a decade. And what we're seeing here is the real growth in foreign-born, largely Hispanic, has been Southeast, South Central, Midwest to a degree, Intermountain West. Well, when you overlay that map with another map, which shows what percentage of the population of adults associate with the evangelical Protestant tradition, most of the same geographies light up: Southeast, South Central, Upper Midwest, into the Mountain West. The reason why the faith leaders, particularly evangelical Protestant faith leaders, coming forward and pushing on this issue is because they are providing new keys to pick or to open new locks in the geographies where we have had the biggest political problems. We've had the hardest time moving lawmakers in the Southeast, South Central, Upper Midwest, and Intermountain West, and we need them to get this job done. We're also working with law enforcement officials. I'm not going to belabor this, but out in California, the sheriff and the local district attorney have begun pushing back against the I-9 audits, which I know have been devastating up in New York and Vermont and elsewhere in dairy. Well, the law enforcement officials are saying these audits are actually making our job tougher because they're thrusting people into unemployment. They need to feed their families. They're being recruited into criminal enterprises, or at least efforts to recruit them into criminal enterprises. Our federal enforcement by, now they're not using the term rogue agency, I would, they're not, but ICE, ICE is making it worse, and so that's a helpful thing as well. The mantra, if you hear this, Bibles, badges, business, the mantra is if you own a Bible, if you wear a badge, or if you hold a Bible, wear a badge, or own a business, you want a solution. So that's good, important new energy that I think is going to be helpful to us in terms of moving this debate. I think that is pretty much what I had to offer. I would absolutely welcome the chance to entertain a few questions if time permits.
All right, Craig, thank you very much. As usual, a great overview of the issue, and I can hear just a touch of optimism in your presentation this morning. We've certainly been at this door a couple times before in the last, I think, 20 or so years. Seems like a long-running issue for us in American agriculture. First question. I think the states of perhaps Georgia, Alabama, Arizona, you'll correct me, but passed pretty draconian restrictions on guest workers a year or two ago. Is there any practical experience that we can take from those state experiments as to what the impact is on agriculture?
Well, I think we all feel for our brethren in those states to the extent that they've been directly impacted. And certainly in Georgia there was a lot of stress and bleeding in the agricultural sector, particularly the sectors that employ more migrant workers, like the fruit and vegetable sectors, because in many cases the law that was passed in Georgia created a climate of fear. it included an E-Verify mandate for a lot of folks, but the E-Verify mandate wasn't even the real problem. It was simply the climate of fear among the migrant farm workforce that they would be profiled and pulled over, apprehended, et cetera. And the reality on the ground is that it's not even necessarily that all of these workers are, in the vernacular of the day, illegal aliens. In many cases, what we have are mixed status families where there are family units present, and one of them, somebody's got legal status and somebody doesn't, and they have a citizen child and they have a child that they smuggled up, and it's just a complicated mess. But the climate of fear was a real problem. I think that the helpful thing at their expense, I'm sorry for that, is that the economic stress that the ag sector faced in Georgia, the losses that have been attributed to it, have kind of helped make the case, folks, this is not the right way to solve the problem. We need a national solution. Some of the most outspoken proponents for a national solution accordingly have come out of Georgia. There's a guy by the name of Paul Bridges, who is the mayor of Uvalde, Georgia, whose economy is based on the Vidalia onion industry. And you look at that industry, if the workers aren't there to do the onion thing, in that particular situation, the farmers can plant a different crop. They can plant a mechanized crop like peanuts or soybeans, but the net returns to the community are a fraction of what they are with high-value vegetable crops. So guess what? The whole economy shrinks, and suddenly Main Street's shriveling. And so I think unfortunately for them, but those states have made that case for us. I do believe we're going to fight some battles in the coming year with hostile state legislation in places. I think Kansas is going to be a battleground state. But for the most part, eyes seem to be shifting back to the feds. And I think the other final point I'll make on that is, to the extent that politicians, Senator Saxby Chambliss, House Ag Committee member Austin Scott, they've got a little more cover to not endless, but they've got a little more cover to solve the problem because of the economic disaster that was inflicted upon them by I guess I would say generally well-intended but poorly conceived state laws.
All right, Craig, I know you have a plane to catch, and we really appreciate you sandwiching this webinar between a speaking engagement, I believe in Ohio, and a trip to another location. So thank you so much for giving us the update and for your leadership on this very critical issue for American and Northeast agriculture. So thanks for being with us this morning.
Yeah, thank you. Northeast has led the nation on this issue for a long time, New York particularly in the Northeast. So don't let up now. I think there may be a light at the end of the tunnel that is actually sunlight.
All right. I'm going to move on to our next speaker, another very good friend of Farm Credit East. I believe he is physically presenting from our Geneva, New York office this morning, and we appreciate him joining our group over there. It's Carl Zimick, and he is a senior extension associate with Cornell University's Pro Dairy program. He's a specialist in environmental regulation. His information analysis leadership has been very critical to the New York dairy industry and really beyond in dealing with various environmental compliance issues. His program efforts are directed towards, first, dairy farm nutrient management and soil fertility issues, and second, development, interpretation, and training of practices that assist AFOs, animal feeding operations, and CAFOs with environmental protection and related regulatory issues. He works closely with Cornell faculty and staff from several departments as well as personnel from state and federal agencies to help bring problem-solving resources to bear on dairy farm nutrient management and environmental challenges. And before I turn the microphone over to Carl, I just want to thank him for a very successful collaboration with some of our folks, Mike Haycock and others from Farm Credit East last year, on producing a nice piece of analysis that really quantified what the impact of the New York State limit on CAFO operations does to expansion of the New York dairy industry. And so, Carl, we really appreciate that work and look forward to future opportunities to work together. But For this morning, we'd appreciate an update on environmental compliance and other related issues. Go ahead, Carl.
Thank you, Jim. And I guess it looks like it's formally afternoon now, so I'll say good afternoon, everybody. I want to say that I've really appreciated the opportunity to partner with Farm Credit East, not only in sessions like this today and in the past, but also on that paper that Jim referred to, looking at the cost of CAFO. I'm going to jump right in and get going. And speaking of the cost of CAFO, many of you know that there was a shift in policy announced by Governor Cuomo at the Yogurt Summit here in Albany in August of 2012. And that shift relates to the paper that we put out and a lot of discussion that's been ongoing about the cost of CAFO for some of those farms that are growing in the 100 into the 200 cow range. And because of some of the costs in this discussion, the governor announced this shift in policy whereby the CAFO threshold will be shifted from 200 cows in New York to 300 cows. I believe this is pretty broadly welcomed by the industry. I've heard a fair amount of enthusiasm about this as I've talked to producers around the state. And that policy shift is I'll say, walking through the process that Albany needs to take to enact it, and DEC has publicly noticed the changes in the regs. The review is ongoing. I know Farm Credit and there were some producers that presented testimony a week or so ago at public hearings around the state. If everything goes as we expect, we should be seeing rules available this spring that will formalize that 200 to 300 cow CAFO permit exemption for New York livestock producers, including dairy. So once we have a clearer picture of what the field actually looks like here in terms of this change, there'll be some guidance developed and made available to the industry in that regard. Another important change, again, this is a New York issue. It's not just CAFO, but a CAFO related. There are some new rules actually that are in a positive way that are being developed for some of the food waste products, notably, I'll say, whey. In these new rules, it's clarifying that CAFO farms will be able to apply or use whey, either adding it to manure storage or directly land applying it under their comprehensive nutrient management plan. In other words, if the whey and the nutrients associated with the whey that are coming onto the farm can be accommodated in the nutrient management plan, then that will be an acceptable whey, W-A-Y, for the W-H-E-Y whey to be used on farms. Other field applications of whey will continue to need to be carried out under DEC regs, Environmental Conservation Law, Part 360. So that's not new. There had been some confusion about how Part 360 and the CAFO plan interacted, and this is a move again by the administration to try to clarify and make things maybe a little bit easier for folks to operate out there in the real world. Again, this change is published along with the CAFO rule change, and I see no reason to believe that we wouldn't have final regs available this spring of 2013. Moving to more of a national level on the CAFO side, some of you may be aware there have been a couple of farms in the news over the last year, 2 years or so that were being sued either by environmental groups or by EPA itself over purported discharges of waste Both of those cases have been dropped or tossed out over the last month or so. And to me, this is one sign of evidence of other signs that I've noted as I've interacted with EPA and observed things that I'm not going to say that CAFO is going to go away, but I think EPA is really doing some soul searching on how are they going to continue to move forward with CAFO. And my hope is that we're going to see a bit more acceptance of state-based solutions or decisions regarding CAFO permits. A lot of the states, so Vermont, New York, Massachusetts, folks that may be listening on the phone, have their own solutions to CAFO, and maybe we're going to see a little bit more acceptance of those on the part of EPA. So I think that's overall a good thing. Really briefly on the Chesapeake Bay watershed, the only thing I want to say there for the folks who are in New York that are affected, parts of 17 counties, mainly in the southern tier of New York. One of the key things for the Chesapeake Bay program is that in order for New York to get credit for the good work that's being done, is there needs to be some accounting of best management practices that farms have implemented and carried out. And there may be folks from the Soil and Water District who are working with the Upper Susquehanna Coalition that might reach out to some of the farms in the Chesapeake Bay Basin and ask for help in terms of documenting the good practices, again, that many of you have been implementing. And so that's not just an idle exercise. That's going to be really important for New York to continue to show EPA that we've done a good job, we'll continue to do a good job, and hopefully if we have good participation and good accounting of the practices that we have implemented and continue to implement, that will help us keep maybe EPA focused elsewhere and allow us to get on with our lives up here to the extent we can. Brief slide on air emissions. You see a slide that my picture there shows California and some areas of the West where there are very, very serious air quality challenges. We tend not to have challenges like that to the same degree in New York and New England, and overall that's a good thing for us. On the air emissions side, I just want to remind folks that most dairies are now exempt from a couple of the federal laws that required reporting of ammonia and hydrogen sulfide emissions, with the exception of large CAFOs are not exempt from the EPCA reporting requirements. On the Clean Air Act side of things, again, a reminder, we don't believe that there would be any New York or Northeast dairies that would trigger Clean Air Act regulations. Unlike a lot of Western dairies, it's a whole different ballgame out there. As many of you know, EPA, through the National Air Emissions Monitoring Study, had been looking at a number of barns, some manure storages and milking centers across the country. There are some gaps in the data, especially for manure storage emissions, and EPA is really kind of struggling a little bit with how to deal with all the data, not just for dairy, but for the other livestock industries that were evaluated or measured. You see on this next slide, broilers, layers, swine, and dairy are on my list. EPA is going to be developing emissions charts for these livestock sectors, and basically you see dairy at the last of the list, and that's in order of priority. Right now, dairy lookup charts are going to be published last as far as we know, and this in fact may be a few years away. This is taking much longer than EPA expected, but that's the way it goes sometimes. Those producers that signed the air emissions consent agreement several years back, just on a conference call here, two conference calls the last yesterday and last week with EPA folks, and it is their opinion that the consent agreement, if you signed it, remains in force. The protections for producers that signed it are in place, and as long as you continue to follow the requirements, it'll stay in place going forward until EPA publishes emissions charts. Pro Dairy will be offering an industry update. We'll be circulating that widely probably in the next coming weeks, maybe a month or two. Again, once these lookup charts are published, everybody that triggers a reporting threshold is going to be expected to make a report to EPA, though again, ammonia and hydrogen sulfide emissions, at this point, there are no requirements to mitigate or reduce those emissions. Another thing I'd like to call attention to is I mentioned that large CAFOs are not exempt from EPCRA reporting for ammonia and hydrogen sulfide, and this is a bit of a problem, and I wonder if the industry doesn't have an opportunity here to take a look at exempting large CAFOs from EPCRA reporting. Have to say that with the opportunities on the immigration side, that's probably immigration's an area we ought to focus our political resources on, but an EPCRA exemption wouldn't be a bad thing to look at either. Flipping back to New York for just a moment, there is a water use reporting rule that was enacted a few years ago. If you use more than 100,000 gallons of water per day in any 30-day period, you're supposed to report to the state of New York. There's a new reporting deadline that's going to be the March 31st of each year. I want to let folks know that Pro Dairy has developed a new water use calculator specifically for dairy farms, and we have reporting instructions. We've not released those yet because we're waiting for final details from DEC on their reporting form for the calendar year 2012. Once DEC gets that to us, we'll finalize our calculator and instructions, and we will set up a webinar again. This will be widely made available to the dairy industry, and folks should be able to rely on finding out about this from their planner, maybe from their lender, or other folks so you can participate if you would like. We do suggest that dairies wait to report until the tool is released. It should greatly facilitate the reporting process. Really, to wrap up really quickly here, I want to mention that I took a recent trip to California, and we saw a number of the things that were mentioned earlier in terms of that Western model and some of the challenges associated with that. Between the stiff regulations and the feed costs in California in particular, doesn't seem to be a lot of growth potential there, at least in the very near term. As I mentioned, EPA seems to be a little unclear about how to deal with CAFO at a national level, and I think that creates some opportunities for state-level solutions. And so I don't see big changes coming there for New York or New England. I think there continues to build a bit of pressure on farms of any size to build and manage manure storage, certainly in the Chesapeake Bay, but elsewhere as well. And to the extent that producers think that their management lines up, their cash flow lines up, and maybe some cost sharing might be available, I would suggest that people start to think about, if they haven't already, continue to think about trying to find some cost-sharing opportunities. I also see some positive development in New York in terms of, at the state level, trying to find common ground with the industry to move forward. I think this CAFO way type of rule changes is one example. Certainly the 200 to 300 cow CAFO threshold change is another example. And from what I can see, especially after visiting California last week, overall the Northeast looks like a pretty good place to dairy. And I don't see any huge black swan type things coming in terms of environmental expectations. I think it's going to be slow and steady, and the industry continues to show great improvement. We just need to keep up just working away at these things as we can. That's all I have, and I want to say thank you.
Well, thank you, Carl. Nice job as usual, and I'm going to say this a little bit tongue-in-cheek, but who'd have figured that the guy with the environmental compliance presentation would finish us off on a very positive note on the future of our industry. So thank you for that. I was actually going to ask you about that, and then you already covered it in your last slide. So we appreciate that perspective, especially since you were the last guy to California. You've got to be the expert on California. A couple of quick questions, and we'll wrap this thing up for today. But any specific advice to Northeast dairy farmers this year that you haven't already covered? One or two things that you might say, make sure this is on your work list or your plan for 2013.
I think, we're going to continue to need to refine and get better on how we feed our crops and how we feed our cows. And so I know many producers have made a lot of progress in that area, and I just urge people not to forget about those things and to keep moving forward in that way as well. As precision ag type things come out, I think there's some opportunities there that we can pick up that can help us get better, feed our crops better, and maybe feed them more precisely. And we need to continue that both on the crop and the cow side. So keep up the good work and don't quit now.
Okay. So my last question, and I'm going to piggyback off of a video that Farm Credit East did that included the dean of your university, the dean of the college in your university, Catherine Barr, last fall. And one of the points that she made very effectively was that we all in this industry, farmers, lenders, other agribusinesses, you folks at Cornell, we've all got to do a better job of telling agriculture's story to the non-farm public. And as I listened to your presentation, we've got some good things that have happened in the environmental area here. Any advice to all of us as to how we do a better job of telling the story of Northeast agriculture to the non-farm public?
I think that it's going to take all of us reaching out to as many people as we can. And so I think that this is not a job we can assign to somebody else, to our farm organizations. It's something that we all have to take personally. And again, I know many producers have done that. I try to talk to as many people as possible as well. But just a reminder that we all have a stake in the industry, and so as individuals, every time we make a touch, those personal communications are so effective, and every person who we can shift at least to middle ground or even thinking much more positively about agriculture is just one less person we might have to worry about later on down the road. I want to say one more thing. There's a story as I see and I drive around this winter, and each winter after the growing season ends, I see more and more fields of green where we've planted cover crops, and I'm going to raise that as a specific example, Jim, and the audience, of a story that we haven't told very well. And I'd love to get data on how many acres of cover crops we're planting now versus what we were doing 5 and 10 years ago, because my eyes are telling me it's huge, and that would be a great story if we could find a way to document it. So I'll end my comments with that.
All right. Carl, thank you so much for being with us this morning and for all the great work you do on behalf of our industry. With that, I'm going to thank all of our participants today for participating in our Knowledge Exchange webinar on dairy. We really appreciate your participation. If you've got specific comments on how we can improve these going forward, or other speakers you'd like to hear from, or anything that will help us do a better job for you, let your local farm credit representative know, or Christy Schmidt gave you her contact information here at the beginning of the phone call, and I think she also has got a slide up here with some contact information as well. So we'd love to hear from you, good, bad, or indifferent, about the usefulness of this webinar and what we can do going forward. For all of you who are customers, we really appreciate the opportunity to work with you. As employees of Farm Credit East, we are proud to have the opportunity to work with a population of really hardworking, successful, productive individuals. It really means a lot to us, and so we appreciate that opportunity at both the employee and the company level. With that, thank you again. We are